Okay, let's unpack this. It is so incredibly easy to get tunnel vision in this game.
Oh, absolutely.
I mean, for the last couple of years, if you weren't holding U.S. mega cap tech, you probably felt like you were losing money every single day.
Every day.
But while the entire world was obsessing over the Magnificent Seven and, AI chips in California, something strange happened.
Hmm.
There is a market that quietly, almost invisibly, outperformed the S&P 500 over the last 12 months. It beat the NASDAQ. It even beat the total world stock market.
And we aren't talking about winning by a fraction of a percent here. We are talking about a significant gap. I mean, it's the kind of statistic that makes you double check the spreadsheet to make sure there isn't like a formula error.
Exactly. While everyone was glued to their screens watching Silicon Valley, a specific region south of the border was delivering a staggering 64% total return.
And nobody was talking about it.
Welcome to another Blueprint to Escape case study. This is where we do the heavy lifting for you, taking the data, the reports, all the noise, and distilling it down to what actually matters for your portfolio and, your lifestyle design. Today is Tuesday, February 10th, 2026.
And just to orient everyone, we are currently in the thick of our 5-part series, which is all focused on geographic diversification.
That's right. This is episode 3. So if you missed the first one where we kind of set the stage on why you need to escape home country bias, or the second one where we looked at European banks, you might want to loop back. But today,
the spotlight is firmly on Latin America.
the mission today is very specific. We're investigating why this case study identifies Latin America not just as some risky gamble, but as the potential favorite market for 2026.
We need to look at the mechanics behind that 64% return and ask the hard question. Is this just a fluke, or is it a trend?
Before we get too excited about these returns, we have to drop the standard disclaimer. We are exploring a case study here. It's for educational, for entertainment purposes.
Right.
We are not your financial advisors, and this isn't personalized advice.
Of course, markets are volatile. Always do your own research or, chat with a pro before you move your money.
Consider us your guides through the data, not the drivers of your car.
Well said.
Fair enough. Let's jump in. When most North American investors think of Latin American economies, let's be honest, the stereotype kicks in. What's the image that comes to mind?
Usually, it's low tech, it's agriculture. People think bananas, coffee, maybe some tourism. It's generally viewed as an extraction economy that just feeds the rest of the world.
And the data says that isn't entirely wrong, is it?
No, it isn't wrong, it's just incomplete. The case study highlights that Latin America is absolutely an agricultural juggernaut. I mean, you look at Brazil, it is the world's top producer and exporter of soybeans. They just dominate the global supply.
Or Colombia.
Or Colombia, ranking in the top 3 for coffee exports with those premium Arabica beans.
And don't forget the salmon. That stat actually surprised me a little.
Right, Chile, the second largest salmon producer in the world. They control something like 25% of the global market. So the farming stereotype, it stands. If you eat, you probably rely on Latin America.
But if that was the whole story, we would be seeing these kinds of tech-like returns.
Exactly. The farming narrative completely misses the pivot. The reason this case study is so bullish on Latin America isn't because of what grows on the soil. It's because of what is buried under it.
Oh.
We need to shift our mindset from an agricultural conversation to a commodity superpower conversation.
This is where it gets really interesting for me.
Yeah.
Because you can't build the future,
Mm-hmm.
all the sci-fi stuff we talk about, without the actual hardware.
Precisely. If I could give you one key takeaway for this section, it would be this. If you are bullish on artificial intelligence, electric vehicles, and the green energy transition, you are by definition implicitly bullish on Latin American mining. You can't have one without the other.
Okay, let's drill down into that a bit. What are the specific materials causing this bottleneck? We're not just talking about gold bars here.
No, not at all. We are talking about the industrial circulatory system, and copper is king here. Chile produces roughly 40% of the entire global output. They have the Escondida mine, which is the largest copper mine on the planet.
And why does that matter to the average investor sitting in, say, Chicago or Toronto?
Because of electrification and AI. I mean, think about an AI data center. It requires just massive amounts of power and cooling. Or think about wind turbines. The copper intensity for these technologies is it's off the charts compared to traditional infrastructure. You physically cannot build them without red metal.
And what about the supply side?
Well, that's the problem. Global mines are aging. Ore grades, which is essentially how much pure metal you get per ton of you dig up, are declining.
So you have a supply crunch.
A supply crunch meeting an exploding demand from the tech sector.
Supply and demand. Economics 101.
Exactly, a supply-demand squeeze. And then you have lithium. We talk about the battery revolution constantly. Well, Chile has the largest lithium reserves in the world, specifically in the Salar de Atacama. If you want EVs, you need Latin America, period.
It's not just those two, though, is it?
No, not by a long shot. Brazil is the second largest iron ore producer globally. Think of the company Vale and their Carajás mine that fuels the world's entire steel industry. And then, yes, the precious metals. Mexico is the top silver producer worldwide. Peru is huge in gold and silver. Even Bolivia is a major player in silver.
So what this all means is it sounds like if you're betting on a high-tech future, you're kind of inadvertently betting on Latin American resources.
That's the so what here. The case study calls it the supply-demand squeeze. We have net zero goals and an AI boom colliding with a finite, geologically constrained supply of materials. That creates price resilience. And that benefits the countries holding the goods.
Okay, so they have the resources, I get that. But let's play devil's advocate for a second. Just because a country has resources doesn't automatically mean it's a good investment for me. I could just buy shares in a U.S. tech company that buys the copper.
Right.
Why should I take the risk of putting my portfolio directly into the region?
That is the million-dollar question. In the case study, it outlines 4 distinct pillars for why a North American investor needs this exposure. It's not about abandoning U.S. tech. It's about accessing things that U.S. tech cannot give you.
Okay, let's run through them. Pillar 1.
Portfolio diversification. But let's define that clearly because people throw that word around a lot. It doesn't just mean owning different things.
It's about correlation, right? Meaning, do they all move in sync?
Right. If you own Google and Amazon, you aren't really diversified. They pretty much move together. Latin American markets often move independently of U.S. and Canadian markets. So when the NASDAQ zags, Latin America might zig. It reduces your overall volatility.
Okay.
Pillar 2. We just touched on it. Commodity superpower access. This acts as a hedge against inflation. When inflation rises, usually commodity prices go up.
And if your portfolio is heavy in tech, inflation hurts you.
Exactly. If you have this exposure, it protects your purchasing power.
Pillar 3 is one I've been hearing about in the news a lot recently.
The nearshoring boom, yeah. For decades, the play was send it to Asia. Cheap labor, massive scale. But now, with geopolitical tensions and the supply chain nightmares we all saw during the pandemic, that calculation has changed.
Manufacturing is coming back, but not necessarily to the U.S.
Because U.S. labor is just too expensive.
Yeah,
Exactly,
yeah.
so where does it go?
It goes to Mexico. It goes to Brazil.
It's the Goldilocks zone. It's closer, the time zones are the same, and the trade policies are favorable. Foreign direct investment is just pouring in to build factories that used to be in China.
And pillar 4, this is the surprise factor for me.
Yeah.
The first 3 make sense: rocks, factories, inflation. That
Right.
feels very industrial. But the 4th pillar is the FinTech craze.
This is the most exciting part of the case study, I think. It just turns the whole developing market stereotype on its head.
Yeah, financial technology. I mean, yeah, usually you think of London or New York or maybe Singapore for that.
But here's what's so fascinating. Innovation often comes from necessity. In the US or Canada, banking is, well, it's fine, it works. You have a checking account, you have a credit card. It's boring but functional.
Sure.
In Latin America, the banking system was fundamentally broken for the average person. The case study notes that over 50% of adults in the region were unbanked or underbanked.
Half the population without a bank account. Wow.
Right. But, strangely enough, 70 to 80% of them had smartphones.
I see where this is going.
Traditional banks were expensive, bureaucratic, and physically hard to access. So digital banks, the fintechs, they leapfrogged the entire traditional system. They didn't need branches, they just needed an app.
And the case study highlights a specific giant here, Nubank.
Nubank, ticker symbol NU. This company is a beast. They have onboarded over 100 million users. I mean, think about that scale. That is roughly a third of the entire U.S. population.
And they just offered fee-free accounts and credit to people the old banks completely ignored.
Completely ignored them, and the growth projections are wild. The market growth for fintech in the region is projected to go from about $15 billion in 2025 to $54 billion by 2034. That's a massive runway.
So, okay, we have resources, we have factories moving in, and we have a digital banking revolution. Now, let's get practical. How does the blueprint suggest we actually invest in this? I mean, we aren't flying to Brazil to open a brokerage account.
No, and that's the beauty of ETFs. The specific tool used in the case study portfolio is the iShares Latin America 40 ETF, ticker symbol ILF.
Right. And just for context, the case study mentions this makes up about 2% of the total portfolio we're analyzing, and it's held in an RRSP for tax sheltering since it's a U.S.-listed ETF.
Correct. It's a targeted bet. It's not the whole farm, but it's a significant piece of the growth engine of the portfolio.
And let's talk about that performance again, because this was really the aha moment for me when I was reading this.
It's startling, isn't it? When you compare ILF's total return over the last year, it hit 64%. Now compare that to SPY, the S&P 500, which had a great year at 27%.
Great year.
Or QQQ, the tech-heavy NASDAQ, was around 18%, and the TSX here in Canada, around that same range.
So Latin America didn't just beat the safe indices, it crushed them.
It crushed them, and it just shows that while everyone was chasing the same big tech stocks, the real alpha was happening in Rio and Mexico City.
So what's actually inside ILF? If I buy this, what do I own?
It tracks the 40 largest Latin American equities, so you get all the big dogs. The top holdings include New Holdings, that's Nubank Vale for iron ore, Itaú Unibanco, Grupo Mexico, and Petrobras.
That sounds pretty concentrated.
It is. Sector-wise, it's very heavy on financials. That's almost 40%, and materials about 22%. So you are basically betting on banks and mines.
And geographically.
Also very concentrated. You're looking at roughly 56% Brazil and 26% Mexico.
So 82% of your money is in just 2 countries. I mean, that seems like a risk the case study should address.
It is, and honestly, that is one of the critiques mentioned. The creators of the case study, and I agree, they wish there was a bit more exposure to Chile, Peru, and Colombia. Those economies are incredibly dynamic, but because Brazil and Mexico were so massive by market cap, they just dominate the index.
So you're really buying a Brazil-Mexico fund.
With a little sprinkle of the Andes on top, yeah.
Still, with 64% returns, it's hard to complain too much about the allocation. But let's zoom in on one of those holdings. You talked about Nubank, the cool new kid on the block. But the case study spends a lot of time on Itaú Unibanco.
Yes, and this is the differentiation point. Nubank is the disruptor. Itaú is the empire. It's the largest private bank in Brazil.
And usually, legacy bank means slow and steady, like owning a utility company or something.
Usually. But Itaú is putting up numbers that are frankly ridiculous for a traditional bank. Their return on equity, their ROE, is 24.4%.
For listeners who don't speak banker, can you just define ROE? Why is that number so impressive?
Sure. Return on equity is basically a report card on how efficiently a company uses the shareholders' money to generate profit. Most Western banks, think of the big names in the US or Europe, they are celebrating if they hit 10 to 12%. 15% is considered stellar.
And Itaú's doing 24.4%.
An absolute profit machine.
And the stock performance followed that efficiency.
Itaú returned over 93% in 1 year.
93%. That sounds like a crypto return, not a bank return.
I know. Think back to episode 2 where we looked at European and North American banks. We talked about Lloyds, TD Bank, JP Morgan, BNP Paribas. Itaú outperformed all of them by a mile.
That is wild.
The only one that came close, or actually beat it slightly, was Santander, the Spanish bank, with a 100% return. But here's the kicker. Why does Santander do so well? Because they have massive exposure to Latin America.
So it actually proves the point.
It proves the thesis, exactly.
So the message is clear. The money is being made in the South. But we can't just look at the rearview mirror. What about the future? The case study mentioned something, or rather a place, that isn't really in the ETF yet.
Argentina.
Now, Argentina has had, let's call it a colorful economic history.
That's a polite way to put it. Defaults, hyperinflation, currency crashes. It's been an economic roller coaster. But the case study identifies a potential shift. There's a massive opportunity brewing there, specifically in energy and infrastructure.
Like what?
LNG, liquefied natural gas. Argentina is positioning itself to become a powerhouse exporter. They're building the infrastructure right now. And because of all that past political instability, a lot of their lithium and copper mines were just underused.
So the rocks are still there.
The rocks are there, and the political will to extract them seems to be changing. The prediction in the case study is that we might see Argentinian companies entering the ILF ETF soon as they stabilize and grow. It's the frontier within the frontier.
That is something to keep an eye on. Okay, let's bring this home. We've covered the resources, the banks, the FinTech, the massive returns. But I want to touch on the philosophy behind this series.
The blueprint to escape.
Exactly. We aren't telling people, and the case study certainly isn't suggesting, that you should dump all your U.S. tech stocks and go 100% into Brazilian iron ore.
No, absolutely not. That would be completely reckless.
Mhm.
It's about asset allocation. It's about balance. The case study views Latin America as an investment hedge. It's the counterweight to your North American exposure.
So if the U.S. market stagnates, this is the growth engine that keeps the whole portfolio moving forward.
That's the idea.
And there's a personal connection here too, right? The creators of this case study, they aren't just reading charts, they're actually living this.
That's right. They mention a nomadic lifestyle spending time in Chile, Colombia, Peru, Argentina. When you're on the ground, you can feel the momentum. You see the cultural shifts, the adoption of technology. It's so different than reading a report on Wall Street.
You realize that these aren't just developing nations in
Well,
textbook sense.
not at all. They're dynamic, hungry economies.
It really highlights that lifestyle design aspect we love to talk about. Financial independence isn't just about the number in the bank, it's about the freedom to go and see these places.
Precisely. Geographic arbitrage. Earn in a strong currency, live where life is vibrant and affordable, and invest where the growth is explosive.
So if you're listening and you want more of this content, more about financial independence, passive income, early retirement, and nomadic life design, please make sure to subscribe. We are digging deep into these topics every single week.
And we want to hear from you. The case study creators asked specifically, what is your favorite income strategy right now? Drop a comment. Are you into dividends, real estate, or are you looking at these emerging markets?
And stay tuned because we are only on episode 3. Episode 4 is coming up, and we are spinning the globe again.
That's right. Spotlight on IFA. We're heading to Europe, Australasia, and the Far East. Broad exposure to the developed world outside of North America.
And for episode 5, it's community choice. So if you have a market you want to deep dive on, let us know.
This series is shaping up to be a real eye-opener on how to build a truly global portfolio.
Before we sign off, I want to leave you with a thought, a provocative one. We talked about Nubank and how 100 million people skipped the branch and went straight to the app.
The digital leapfrog.
Next time you are standing in line at your local bank branch, filling out a paper form with a pen that's attached to a chain, or waiting on hold for 45 minutes for customer service. Think about the teenager in Sao Paulo managing their entire financial life instantly on a smartphone.
It does raise the question, in the grand scheme of things, who is actually developing and who is falling behind?
Something to mull over. Thanks for listening to this Blueprint to Escape case study. We'll catch you on the next one.
See you then.